Good day and welcome to video 4 here in our series at the Expat Teacher Network. We want to start this video the way we start all of our videos with our two disclaimers or our two notifications. One is to mention that at the Expat Teacher Network we are not CFAs, Certified Financial Advisors or Planners. We're simply trying to pass on information in the hopes that our fellow expat teachers can avoid some of the pitfalls that many of us, including myself, have fallen victim to. And so please remember that any advice that or any decisions that you make about your financial planning, you need to make in conjunction with either a good financial advisor or based on your own experience. Many of us at the Expat Teacher Network, including myself, we don't use a financial advisor. We just do it on our own. The second thing is to remind viewers and members that this video is part of a series. As I said, this is number 4. There will be things in this video that if you have not watched 1, 2, and 3, you won't understand. So it really helps if you go in order, okay? So without further ado, what we're calling our video today is Keep Calm and Carry On. We're basing a lot of this video on Rule 4 of the 9 Rules of Wealth You Should Have Learned in School, which is the subtitle of our colleague Andrew Hallam's book, Millionaire Teacher. And in Rule 4, he calls it Conquering the Enemy in the Mirror. We adjusted the title a little bit, but basically what we're talking about here is avoiding self-destructive and self-defeating behaviors that many investors do. Statistically, most investors, even if they're in index funds, don't match the return of the market. They don't do as well as the market does. And we'll talk today about why, and most importantly, we're going to talk about how to not be that person, okay? So the first thing we need to deal with is this basic question: why isn't everybody rich? And it seems like a silly question perhaps, but the truth is if you ask somebody, how do you make money in the stock market? They always give you the same answer: buy low and sell high. Everybody knows this, right? It's common knowledge. And yet if you actually open most people's portfolios and look at their spreadsheets and look at what they've bought and sold, very few people actually do this. And when you think about it, it's one of the reasons why we called this slide Courage Camille. In order to buy low and sell high, it means you've got to buy the stock nobody wants. You've got to buy the stock that everybody figures is, poisonous or they're treating it like Typhoid Mary. And you've got to sell the one that everybody's clamoring to get. So the one example, and I freely admit this is an example of a missed opportunity. Toyota in 2009 had a problem with their brakes, and so they recalled millions of cars. And they were all over the news in not a good way. In Hollywood, they say there's no such thing as bad publicity. Well, in the business world, oh yes, there is. And Toyota was really suffering from a lot of bad publicity because specifically the recall had to do with their brakes. And the stock fell from $80.02 to $75.91 in just a little over a week. I checked these prices myself, so I do know that these prices are accurate. And the conventional wisdom, I remember driving in my car and hearing this story break on the radio, and this conventional wisdom from some financial guru was, stay away from Toyota stock. Toyota's finished. Toyota's over. Well, to make a long story short, as of 3 days ago, I checked the price, July 2015. So today's July the 30th, so this would have been the price probably on about July the 27th, something like that. It was $132.55 on the New York Exchange. And, I don't know what else to say other than if somebody had bought that stock at $75, even if they had held it for only a few weeks, they could have sold it for a profit. And so that's an example of buying the stock that nobody wants, buying low and selling high. I don't know too many people that would necessarily want to sell their Toyota stock today because they think, oh no, it's doing well, it's doing great. And yet, buy low, sell high is what everybody knows you have to do. So if you look at it another way, one of the questions you could ask yourself is, could you have had the courage to buy stocks following 9/11 when the markets tanked for about a week or so? It may have been longer than that, I forget. Could you have jumped into the market eagerly following the crash of 2008? And the answer with most people is probably not. Probably they wouldn't do this. And yet, objectively, these were the best times in the last 15, 20 years to buy stocks. These are the times when stocks were basically on at bargain prices. The way Warren Buffett says this is, unless you're going to own a herd of cattle, would you rather buy the hamburgers at the discount price or at full price? He said only a fool would buy it at full price if it was available at discount price. Okay, So now that we know why or how people do this, that it's really an emotional thing, right? It's really a psychological thing that people have to overcome. The problem is overcoming that isn't so easy. It's not so easy to swim against the herd. It's not so easy to swim downstream when all the other salmon are swimming upstream. So let's talk about some strategies that you can do in order to avoid this kind of behavior. And the easiest one, the one that you may even have heard of, maybe you're even already doing this. If you are, kudos to you, is dollar cost averaging. Now, this assumes something. This assumes you have an investment plan where you're kicking in a certain amount of money every single month. And you're not simply slapping down, I don't know, 10 or 20 or 50,000 euros or dollars or pounds or francs or whatever you have because you've happened to have a windfall from, I don't know what, an inheritance or something like that. This assumes that you're contributing to an investment plan every single month. And if you are, and if you inject the same amount of capital every month, if you save $300 or 500 euros or 1,000 pounds every single month, this is to your benefit. And the reason being is there's 4 things that anybody can say for sure. These are absolutely dead certain, unlike a lot of the advice that you see on financial news shows and these gurus saying that, you know, such and such is going to happen and such is going to happen. Because even these news shows like CNBC, it's one of my favorites, where I remember watching an episode where they actually, it was in about June, they have these 3, you know, supposed experts. I don't even remember their names. And they had their track record, and none of them was more than 55%. None of them had predicted correctly what the markets were going to do with a greater efficiency of more than 55%. And I couldn't think of a better advertisement for throwing your money into index funds and simply letting it ride than that. But the idea is that the 4 things anybody can say for sure are: 1, at some point stock markets will go up. 2, at some point after that, stock markets will go down. 3, at some time the price of bonds and bond indexes will go up, and on other days bond indexes will go down. That's just true. So with dollar cost averaging, the question becomes is, how do we take advantage of that? Well, the truth is we do it by simply, as I said, injecting the same amount of capital every single month. And the reason for this is it forces you to buy more units or more shares when the price is lower. If the price is dipped and you're still putting in $500, pounds, euros, whatever, you will buy more shares. It's not possible not to. And it comes from this understanding, this basic understanding. When you've had your account in your portfolio for 30 or 35 years or 25 years or whatever it is, the key to building wealth is not massive increases in share prices, okay? It's building shares. It's accumulating and increasing the number of shares. And this is one of the reasons why on this particular slide I've put Remember Grace Groner. If those of you that watched, I believe it was our second one in our series, where we talked about the magic of compound interest, money owning versus money lending. And we had this example of Grace Groner, who worked for Abbott Laboratories and bought something like 3 shares or 2 shares. It was this ridiculously small amount. And in 2010, when she died, the account was worth $7 million, even though she'd only paid $200 in 1935. And if you go back and look at that slide or look at that presentation, you realize that one of the biggest reasons is share splits. And the other big reason is reinvestment of dividends. So in other words, for free essentially, when she got her dividends, when she got her share of the company's profits every year, she plowed them back into more shares. And with certain unit trusts or mutual funds, especially index funds, there are basically 2 types you can buy. Those where the dividends are paid out, you get the cash, and those where the dividends are automatically reinvested. I admit I tend to put my money into ones where the dividends are automatically reinvested because I want to accumulate shares. If I start with 10 shares or 10 units, I don't want to end up with 10 hoping that the price will be 1,000 euros when I paid only 100 euros for them. I want 1,000 units. I want 1,000 shares. I want 10,000. I want 50,000. I want more shares at the end of the day than I started with, and I want it to be a lot more. And the reason being is that by the time I factor in inflation and the earnings of the companies, even if it's an index fund and it's indexing the entire market, the earnings of all these companies, by the time I factor in inflation and all kinds of other economic data, the price per share probably isn't going to be hugely more. it's probably not going to be a whole lot more than it was. And so the way to accumulate wealth is to build shares. And as we say here in our last 2 bullet points, markets always move up and down. This has always been true, and it always will be true. And so with dollar cost averaging, we can take advantage of this, and it's simply a matter of consistent contributions. So we're buying more when the price is lower, and yes, we're buying less when the price is higher, but it averages itself out. And it allows us to take advantage of those peaks and valleys. Okay, anyway, now that we've got one strategy, let's talk about other strategies to build a winning hand. This is one of the reasons why we chose this particular template for this particular presentation. We kind of wanted to view it as like you holding the cards in a poker game or in some sort of card game, and how do you build the winning hand, right? Well, one of the ways, frankly, is that ignorance is bliss. I admit I'm kind of addicted. I check the markets every day. I want to see what's moving up and what's down. But the one thing I refuse to do is I refuse to watch CNN Money. I refuse to watch Market Watch on CNBC. I refuse to watch any of these financial news shows. I will sometimes use Yahoo Finance to gain information. If I want to know the share price of a particular stock that I'm thinking of buying, or a particular index fund, or if I want to know the ticker symbol. Like I know it's Vanguard's total stock market ETF, but I don't know what the ticker symbol is. I'll go to Yahoo Finance to look that up. But I will not watch these shows where these gurus are talking about, this is going to happen and then that's going to happen, da-da-da-da-da. And the other thing that I try to ignore is market swings. I have to steel myself and understand that the market is going to go up and it's going to go down. Yesterday, for example, on July 29, 2015, I believe the Dow at the close was up by something like 128 points, 127 points, something like that. It was in that area anyway. And the day before that, it was down, if I'm not mistaken. Certainly the DAX, I live in Germany, the DAX in the last couple of months has been going down. But in the first 3 or 4 months, the DAX was going crazy. It was going up, 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 up. And so this downswing, frankly, it didn't take a genius to figure out that it was coming. And the other thing that can be difficult to do is to ignore advice from speculations or speculators is what we should have written there. No, we got that right. Yeah, we got that right. Ignore advice and speculations from financial gurus and experts. And here's one where I'm forced to tell my own story. I once bought, yes, I had to pay money for it because all these guys charge money. I bought a membership in something called the Speed Retirement System. It was run by a guy named Ian Cooper out of New Mexico. He was working for a company named Market Authority. He doesn't work for them anymore. He works for a company called Trader Insight now, and I freely and openly tell you this information. My mistake was this. His system, so he said, was the buying and selling of options. We'll talk in a later video about exactly what those are. And the idea was that if you listened to his advice and bought and sold these options, you could retire like within 10 years. And like a fool, I paid for this. I paid something like $200 or $300 US per quarter. So it's like $1,200 a year. And fortunately, I only lasted a year before I realized that the speed retirement part of Speed Retirement System was Ian Cooper's speed retirement. It had nothing to do with my retirement. To make a long story short, I started with an account of $10,000 and it's barely over $5,000 today. I lost about half. And part of the reason was listening to bad advice from somebody who claimed he could predict the market. Now, there are technical indicators you can use with things like options to predict what might happen the majority of the time, but the truth is no one can know. And what's also true is you have to avoid these knee-jerk reactions. You have to avoid moving your money in large ways based on one news story or one item on the news. I remember once buying shares of Aer Lingus or Bank of Ireland, which I did eventually sell for a profit, but it's because I read an article in the International Herald Tribune, not being smart enough to realize that by the time the article had made it into the Tribune, it was already public knowledge and had been for days, if not weeks. I still made a small profit on it, but it was still a dumb idea. Okay, well, our last strategy that we talk about is simply to say that patience is a virtue. And look, this comes from understanding something very basic. And this is something Andrew Hallam mentions in his book too. It's his slogan. I admit we stole it. It's time in the market, not timing of the market. If people are coming at you telling you that they can time the market and make you a lot of money, walk away, because they're wrong. They can't. And even people like Warren Buffett and John Bogle. John Bogle is the founder of Vanguard, and he wrote a book on investing as well. And his attitude is simply says, I've never known anybody that could predict what the market was going to do and could time the market. And he said that not only that, he said, I don't even know anybody who knows anybody. Right? It's just not possible over the long term. And a lot of this has to do with our video on the magic of compound interest. And if you remember, it's this idea of a snowball effect, that in the beginning, your compound interest isn't really earning you a lot, and you think, this isn't going very well. But then eventually, the account builds itself and the portfolio builds itself to the point where 10 and 12% of the amount that you have becomes a fair bit of money. If you remember our example of the person that started out with $5,000, well, you double it to $10,000. That's not a great gain. It's certainly nothing that you can retire with. But by the time it builds itself to, say, $160,000 and you're doubling it over 6 or 7 years, remembering our rule of 72, you're up to $320,000. And then you double that, and then you double that. Well, by the time you're doubling $600,000 or euros or pounds, I mean, my goodness, that's more than enough for most people to retire on. But the truth is, in order to accumulate that desired snowball effect, there's one ingredient that you cannot get around, and that is time. You need time. So really what we're saying here is it's not about trying to predict when is the market going to swing up and when is it going to fall. It's about simply putting your money in the market and leaving it there for 25 or 30 years, or as long as you can. And the longer you can, the better off you are. And we've talked about that in other videos, so I won't go into that. The idea is this, that stock prices will always return to the mean. One of the examples that Andrew Hallam gives in one of his books is Coca-Cola, where by 2007, the price of Coca-Cola, or I believe it was in 2005 maybe, the price of Coca-Cola had shot up like a rocket. But when you looked at the earnings per share, the price shouldn't have been that high. And his argument is, and it's a strong argument, that over time, a stock price will always find a way to come back to its earnings per share. Because at the end of the day, that's really what the stock is actually worth. If the company liquidates everything and starts farming out the money, that's what it's worth, is the earnings per share. Stock prices on a market can be affected by emotional factors, but these emotional factors are always short-lived. Toyota is the perfect example, right? People realized in fairly short order, okay, Toyota had a problem with their brakes. They did a recall, they fixed the brakes, and now everything's fine, and we're back to the point where Toyotas make really good cars. And so it's okay to go buy a Toyota, and people know that, and so that stabilizes the share price, because there's no reason why the share price should be lower than the earnings per share. Well, probably the best example of this is the dot-com boom and bust in the late 90s and early 2000s, right? And the best example is Nortel, where it skyrocketed to $150 a share, in spite of the fact that not just on paper, in reality, the company was losing money. If you looked at the company's quarterly financial reports, they were losing money and the share price was going through the roof. That's not sustainable. And eventually, of course, if you own Nortel stock today, you own nothing, basically. Like they collapsed and essentially went bankrupt and kind of went down sort of the same road as, what's the other one, Enron, although that was for very different reasons. But still, it's a perfect example of how share prices will always come back to earth. And the opposite is true, too. If share prices are lagging well below earnings per share, eventually they're going to come back. Eventually they're going to get back, because the buyers in the markets will realize, wait a minute, this stock is way undervalued. Now, of course, if you're clever, you can do a lot of research and find these undervalued stocks and buy into them. But we're not going to deal with that today. That's something for another day. Okay, so our last strategy then is simply to say patience is a virtue. That's really it for today. We wanted to keep it a little bit shorter than the last couple of times, and there's our list of sources. And so what we're saying here today is simply keep calm and carry on. Use these strategies, dollar cost averaging, patience. Remember, it's time in the market, not timing of the market. And to understand that building shares, not price per share, is the way to accumulate wealth. And as long as you can do this, you can do what Andrew Hallam suggests, which is conquer the man in the mirror. What we suggest at Expat Teacher Network is just keep calm, put your money in every month, and kind of halfway forget about it. And eventually, you'll reap the rewards of it. So from all of us at Expat Teacher Network, thank you for watching. Stay tuned for video number 5, which will talk about financial advisors and how to pick a good one. That's going to come really soon, so stay tuned for that. Okay, until then, we'll see you next time.